So, Peter, first question. How do you differentiate Anchor from the likes of the banks and other assurers when your structures are so similar?
So I think that's the whole point, is there are a huge amount of great brains out there creating structures and opportunities. When I worked at the banks, you had to use those banks' products, so which weren't necessarily the best ones at a point in time. I think we don't try and create structures. We manage people's money, we look after them, we help financial advisors, and we try and get returns off assets. But I think we've got we know what product and structure is suitable for what client. We know which ones to use. And so Anchor is not competing with the banks and insurers from a structure point of view. We're helping sell it to a client, assessing which one is right. And I think something that's underestimated is the relationships with the product providers and knowing who to ask what question. So we know for a particular type of client who's got this type of problem, the Old Mutual endowment is most appropriate. The Hollard endowment is appropriate for this client in that situation. So we So you also can't really work with the banks to win a client over. If you go to a bank, they're going to try and take the client from you. I think we're not positioning ourselves as competitors with the banks. We use the banks and insurers, but work with financial advisors to provide the right complete solution to a high net worth client.
Peter, next question. Would you mind explaining the concept of partnership that an IFA would have with Anchor Capital, keeping in mind the nervousness of losing the client to Anchor Capital?
Yeah, sure, absolutely. I mean, so one of the, when we started our business, we can only have so many distribution people in our business. We've always valued the financial advisor partnerships and grown our business with them. In a business like ours, if there was one instance of a financial advisor losing a client to us, that would effectively close that channel down to us completely. So, we operate on a business on a basis of trust. I can confidently say that our business has never operated in a way where we take something from a financial advisor. We've got, I'd say, going into hundreds of three-way relationships. We've got some financial advisors that we work with fantastically, where the client meetings are with the financial advisor, ourselves, and the client. And we really deal with the financial advisor tells us how they want to operate. So we can merely be the asset manager in the background. Our portfolio managers are happy to attend the meetings. Every communication the IFA is kind of factored into. But being a value add to financial advisors, we're going to grow our business 5 times faster than simply trying to do it ourselves. So the partnership really is defined by the financial advisor. And it's relationships that we work with over time. And we have absolutely no desire to we want a financial advisor to grow their business if they're supporting us.
Peter, how do you handle the cost of bringing in an outside expert? For example, tax advice. Do you pick up the cost or do you request the expert to go on risk?
Yeah, so I think it's quite client specific. I think people are prepared to pay for good advice, particularly if you see what the big tax experts and guys work with. If it's going to be if we've got a big client where we know there's a big revenue, we're very willing to go and get some advice on different aspects and bear the cost ourselves. If you don't have a high confidence level, if you don't have a high confidence level in getting a client, I think it's quite appropriate to ask the client, that you'll get the work done, but there's an external charge. So I do that as a default. But if you've almost got a client over the line, or it is a current client, I think it goes down very well to kind of take on a bit of the cost.
Peter, question: I understood financial advisors must work for Anchor Capital. We are totally independent. Could we work with Anchor? Yeah,
so I mean, like I say, we have hundreds of financial advisors who work with us. we've got a big portfolio management department. So the most typical one that we do is we run segregated portfolios for financial advisors. So, the financial advisor, we work with them a lot more with high net worth clients, where the guy actually wants to have an interaction with the person who's buying and selling the shares. They want to hear some share views. They want to hear some perspectives. So the financial advisor can use us for certain things, can use other people for other things. So it doesn't stop the financial advisor's independence. But, across our business, probably, a large, in certain parts of our business, as many as 50% of the portfolio managers, 50% of their assets is money managed for financial advisors. So, when you talk about partnering with experts, we think we're particularly good at specific things. And others are better than us at other things. So, if you agree with our evaluation in terms of those categories, partner with us and we'll provide a great service to your client on your behalf.
Peter, I'll answer the first part of this question. How do I get you to see my client, and how much money do you need before you will personally see them? So the first part is if you need Peter to see a client, please mail me and I'll arrange it, and I'll let you answer the second half.
Please mail me. What's the second half, sorry?
The second half is how much money does the client need to have before you will see them personally?
Yeah, it's obviously we're running assets and time is a valuable commodity. If we've got typically our core relationship is with the financial advisor. And we've got guys who've worked with us for 5 or 10 years. And if somebody's important to them, and it's important to match the right person to the right client. So there's certain people where I'm not the appropriate person, where, Daryl Hannington or Matthew Norwood Young or somebody else might be appropriate. Matthew, one of our guys, he's got a smart haircut and shiny shoes and tight pants. I've told him he must never cross the Yexkay River. He wouldn't go down well in Pretoria. I say it to him jokingly. But, on a serious note, if one of the financial advisors we work with, if it's an important client to them and they think it's important for a specific person to go with them, we very seldom not available.
Peter, what is your view on 12J investments as a tax planning option?
Yeah, we like it. I think it's a great tax dispensation for guys looking at it to remember that you are now limited to 2.5 million rand a year. And it's a lot of money, but it's, for high net worth individuals that disappears quite quickly. I think an important point with that is people get carried away with the tax aspect and forget about what the money is actually invested in. So, I want to see a combination of an investment that I'm happy with together with getting the tax benefit. But it's there's no question marks against 12J from a tax point of view. A lot of the other tax planning initiatives are grey areas and rely on interpretations from SARS and the like. 12J is cut and dried. It's very open legislation. You're not taking the tax risk of not getting the tax benefit. But we would just urge you to make sure that you that the underlying investment itself is sound. So putting money away just for tax, if you're in a bad investment, is a bad idea. So we work quite actively with Westbrook, the biggest players out there. Our industry is small. It's you want to work with people that you know and you trust.
Peter, what exactly is a Section 42 transfer?
Section 42 transfer is when so typically, in the case of a company, which is where it all started, if a company had 2 subsidiaries and they wanted to reorganize assets under the same holding company, the legislation was put in place where they could transfer assets without it being a tax event. It's not viewed as a sale and hence triggering a tax event. The same thing applies with listed equities, where you can if you let's say you sold 100 shares and there's a base cost of 50, instead of paying capital gains tax on the 50, you can transfer the assets into a collective investment scheme. So if you transferred your Naspers shares into a collective investment scheme, as long as your motivation is diversification as opposed to trying to avoid tax. What's important with this is you're not avoiding tax in any way. You simply are not paying the the transfer of shares into a collective investment scheme is not creating a tax event. That base cost is carried forward, and when you sell out of the collective investment scheme, you still then pay the capital gains tax. But it presents the opportunity for people with big share portfolios or big weightings in a particular share to diversify without creating a tax event.
Peter, could you please share the most accepted performance fee model?
Yeah, so, when you, obviously the standard ones in hedge funds, so in hedge funds, it's typically 0.75 to 1.5%. And then an industry is kind of coming out at about a 15% return over a certain hurdle. That's often STEFI or 5% or 10%. When you work with high net worth individuals, now we're talking pretty large sums of money. The guys have typically there's a psychology around the return that they're looking for. So we've actually dealt with quite a few clients in the last year where they go with the offshore money. In their head, they should get a 5% return. So I don't want you to earn a lot of money out of me unless you earn a 5% return. So we've manufactured quite a few equations with people where our actual fee is pretty low, but we share in 10 to 15% above a 5% dollar return. And that's something we typically say, there's our standard fees. That's what the financial advisor's charging. But if you'd like to pay less fees, we'll only share in the upside. And that makes sense as a part of your business. You obviously don't want your whole business to run like that because investment markets can be poor for some time period. But certainly does make sense. It's nice to have a mix of that. When the markets do really nicely, everybody makes a lot more money.
We still have a lot of questions, so I'm going to do the final few. Peter, just one more question on Section 42. How do you get around the 3-year rule on not selling?
The 3-year view on not selling shares. I assume what they're talking about is in equities, where what the receiver of revenue has said is that if you own a share for 3 years, it won't be taxed from an income tax perspective. That doesn't mean that if you sell it before 3 years, that it does get taxed from an income tax perspective. And in fact, in my lifetime of managing equity portfolios, I've never had a client whose portfolio we've managed be taxed at income tax as opposed to capital gain tax. Where people have trading portfolios, that certainly is a lot more relevant. And a lot of guys who run trading portfolios must understand they're going to pay income tax. But when you're running a long-term portfolio, typically with a portfolio manager, the intent is not to trade in and out of shares. The long-term investment decisions that are made. Typically, every share that we buy, we're taking a 3-year view right up front. But the other way to deal with that is, the majority of our share portfolios are in things like the old mutual wrapper or in the Hollard endowment, but that's not an issue at all.
Peter, final question for today. The S&P 500 forecast for the coming year, is it better than SA equity?
So we're kind of coming to the sort of halfway through our process. At the June investment stage, we were forecasting a fairly muted return from global equities as a whole, kind of single digits. The market subsequently gone up another 3 or 4%. So on a 12-month view, we're quite cautious about index levels as a whole. You're sitting about 3 or 4% above all-time highs. So we're quite nervous to go full bull into global equity markets. Having said that, that's the index. Underneath that, there's still lots of opportunities. Henry Biddlecombe wrote a great article yesterday morning, if anybody wants to read it, pointing out that in global equity markets, or in the S&P certainly, a lot of shares are up 40, 50%. There's still some great companies that will recover that are sitting 20, 30% off their highs. In the local market, I think of Bidcorp yesterday. So Bidcorp is a global food services business, so supplying hospitals, prisons, restaurants, etc. And their run rate currently, they went down to 40% of the previous year's turnover in April. In August, they're now running at 89%. And we think within 3 or 4 months, they'll be at the same level as a year ago. So in 6 months' time, they're going to be the same business that they were 6 months ago. And the share price is off 40%. Great quality business, one that I'm prepared to hold for the long term. So when you go and look at individual shares, we can still find share opportunities that we still look great. The index as a whole, a lot of the good quality companies have recovered and are 10% ahead of pre-COVID, which is full. So we wouldn't be rushing into markets. From this level, our range of returns from an S&P on a 12-month basis would probably be 0 to 5%. The SA equity market, ironically in Rand terms, our projecting is a little bit higher, probably around the 10% level, because we think Naspers will do well. We think resources will continue to do well. We think local equities have bounce potential, but don't look particularly exciting given the economic growth. So we're not particularly excited about the local market. But, in dealing with a high net worth individual's money, you're taking a 3 or 5 year view on where they should be from a strategic asset allocation perspective. And then you employ it with the kind of thinking and logic that we're applying now.
Thank you very much, everybody. That concludes our session for today. We will send out a copy of the presentation and of the webinar to your email address. Thank you very much for attending, and I look forward to seeing you at the next session. Bye-bye.